Joining us this morning, BofA analyst Nat Schindler, who, Nat, threw some cold water on some of the enthusiasm regarding the ad product yesterday. Why do you argue that the reaction of the stock lately has been just about the company putting pen to paper, in your words?
Well, this is a company that's basically changed from a high-growth subscription business to a low-growth media business. And that change is, one, very difficult. And two, it's not necessarily as profitable as I think people are thinking. It's profitable in the US. There's almost no way they don't make more money on their ad-supported tier in the US than they do on their current subscription model. But outside of the US, it's much harder. CPMs or ad pricing in Germany and France, so it's only about 40% of the US level. In Brazil, it's 5%. It's extraordinarily difficult to make up the subscription revenue lost from the ad tier when you switch to a lower priced ad tier product.
Do you see any accretion to this new ad model or even from password sharing?
Well, the password sharing is still nascent and it's still a very tested product that is difficult to do and is kind of voluntary at this point. So I'm not going to really write that as a major driver anytime soon. And the company is holding off and saying, if anything, it affects 2024 or later. The ad product will have an impact in the US. It really depends on how many people downshift from their current $15.50 subscription, which is the normal standard tier, to this new low price $6.99 subscription price. That's is really hard to know because this is a very different product. It's not just ad supported, it's also not HD.
Right. So, Nat, you're saying that Netflix, essentially, what was a high-growth streaming business is now a low-growth media business. What is the right valuation in that case? Does its multiple ultimately come in line with some of the legacy media players? I know that you note that the steep premium already, nearly 220 times price to adjusted free cash flow. How much lower does it have to come down? I would think a lot if that's the business model.
Yeah, I mean, there is ways that they could get free cash flow higher, and maybe it does come up higher than what I think or the street thinks, but it has to come a long way before it starts looking like media companies. And if you're looking at sub growth, I mean, the sub growth for this quarter is only expected to be 1 million, with the street thinking about 4 million for next quarter. That means for the whole year, you're almost flat. So without real sub growth, and once this ad product takes off, you're looking at basically in line with macro growth type business like other media companies. So it needs to be multiples that are much closer to that. So they're have to cut expenses dramatically as well as see their stock price fall, in my view.
Nat, here's the potential catch-22 that I'm trying to figure out when it comes to Netflix and an ad-supported version. Don't they need a certain amount of scale on that product for it to work, and therefore they need people to downgrade, but that's actually kind of bad at the same time? And then if they want to grow that ad business to be able to target it better for the benefit of certain brands, don't they need it to continue to grow over time?
Yeah, this really goes into what's the real elasticity of demand of Netflix. And quite frankly, no one knows that, even Netflix, because they've never had really much variation in price. So, and you've never been able to do real price testing. They move their prices in entire markets all at the same time. So if you look at how they could possibly do this, they need to know not only will they get a downgrade from a normal price subscription to a lower price subscription and a lot of ads on top of that, which is possible in the US, that can work and be profitable. It is for Hulu. They make more money on their ad-supported tier than on their subscription tier.